All right, welcome. Today, we're going to be financial detectives. We're going to look past all those flashy headlines, those big profit numbers, and really find out what's actually happening inside a company. And it all starts with one single, really important question.
So let me ask you, you see a company posting these record profits. Is that an automatic green light? Like, should you just jump in and invest? Well, you'd think so, right? But honestly, it's a lot more complicated than that. Because profit, well, it doesn't always tell you the whole story.
And that right there, that's the heart of our whole investigation. On one side, you've got the official story, the reported profit. And look, that number can be, well, let's just say it can be shaped by accounting rules, sometimes even manipulated. But on the other side, you have the real story, the actual cash flowing in and out of the business. And that is the ultimate reality check. You just can't fake cash.
And hey, don't just take my word for it. The legend himself, Warren Buffett, built his entire career on this exact idea. He knows that real, long-term value, it doesn't come from some number on a profit and loss statement. Nope. It comes from a company's ability to generate cold, hard cash and then spend that cash wisely.
Okay, so where do we start our detective work? Our investigation begins with the very first and maybe the most important clue. We have to follow the operating cash. This is where you see if the company's core business is truly strong or if it's all just smoke and mirrors.
So let's break this down. Operating cash flow, or OCF. The simplest way to think about it is like this. It's the company's salary. It's the cash that comes in from its main job, selling its products or services, day in and day out. This number is ground zero. It's the fundamental starting point for figuring out if a company is truly healthy.
Okay, here's your first real detective tool. It's a simple ratio. You take that operating cash flow we just talked about and you compare it to the net income. Now, if that ratio is above 1.2, that is a fantastic signal. It tells you that for every single dollar of profit the company reports, it's actually bringing in $1.20 in real cash. That's exactly what you want to see.
Let's put this into practice. Take a look at Asian Paints, a huge paint manufacturer in India. In their 2024 fiscal year, their OCF to net income ratio was 1.17. Now that is a super strong indicator. It tells us their profits aren't just some numbers on a spreadsheet. They are backed by solid, real cash generation. But a good detective also needs to know what red flags to look for. And here are some big ones. For instance, if that operating cash flow is always lower than the net income, you got to ask why. Or what if their inventory is piling up way faster than their sales? Or they're taking longer and longer to pay their own bills? These are all clues, signs that the company might be struggling to turn those reported profits into actual cash.
All right, so once we've confirmed the company's got healthy cash coming in from its operations, our investigation moves to the next level. Now, we're on the hunt for the real treasure. We're talking about free cash flow. This is the money that's left over for the owners of the business after all the essential bills are paid.
And you know what? Figuring it out is surprisingly easy. It's a two-step process. You start with that operating cash flow, the company's salary. Then you just subtract what it spent on capital expenditures. We'll call that CAPEX. And what's left over? That's it. That's the free cash flow. That's the real pot of gold.
But what is CAPEX, really? I mean, it's not just one thing. Think of it like a budget. Some of that money, maybe 40%, is just for maintenance, keeping the lights on and the machines running. But then a big chunk, say 35%, is for growth, to expand the business. A little is for efficiency, and some is for regulatory stuff. Seeing how they split this up tells you if they're just trying to survive or if they're actively investing to win. And let's circle back to our case study, Asian Paints. Just look at this trend. Even though they're spending money on CAPEX to grow, their free cash flow is still climbing, and climbing consistently, up, up, up. This is what a cash flow champion looks like. It's a business that can invest in its own future and still have tons of cash left over.
Okay, so we found the cash. We know it's growing. But now we need to dig into the company's habits. How good is it at managing all that money day to day? This is where we really start to follow the money trail.
This leads us to something called the cash conversion cycle. Now, it sounds kind of technical, but the idea behind it is incredibly simple. It all boils down to one question. How many days does it take for a company to turn its investment in products back into cash in its bank account? And you guessed it, the shorter that cycle, the better.
And the difference between industries here can be just night and day. Think about a grocery store. They sell stuff so fast, they might turn their inventory into cash in just a couple of weeks. But a big manufacturer? Their money could be tied up for months in raw materials and unfinished goods. A shorter cycle is a really powerful sign of an efficient, well-oiled business machine.
Okay, So the company is making lots of free cash. It's managing it super efficiently. What's the last piece of the puzzle? Well, it's finding out what they do with all that cash. How a company chooses to spend or allocate that capital, that reveals everything about its strategy and its priorities for the future.
And here's the hierarchy, the priority list that shows you if they're disciplined. The best companies, the smartest managers, they first look for ways to reinvest that cash right back into their own business, as long as the returns are good. Only after they've run out of those great internal opportunities do they start thinking about paying down debt, making a big acquisition, or returning cash to you, the shareholder. The order here is so important.
Wow, we have covered a ton of ground in our investigation. So let's wrap this all up. Let's put it into a simple, actionable toolkit that you can use on any company. These are the key clues you're now fully equipped to look for.
So here it is, your brand new financial detective kit. Just 4 simple but incredibly powerful questions. First, is the cash from the core business higher than the reported profit? Second, is that leftover cash, the free cash flow, strong and growing consistently? Third, how fast does the business turn its stuff into money in the bank? And finally, what does management do with all that extra cash? Where are their priorities?
So, you now have the framework. You can look right past the headlines and see the real story, the one that's written in a company's cash flow. The only question left is, now that you know how to follow the cash, whose real story are you going to uncover first? Thanks for joining this explainer.